Hi everyone. In the next maybe 10 to 15 minutes that I have on YouTube, I'm going to offer a perspective on what's going on in the markets and at the same time debunk the rodeo clown, the blowhard. You know who he is. Now, he said tonight, and I just wanted to run this by you or show you, he wanted to explain to you now, 2018, August of 2018, not in August of 2004 or 2005 or 2009, 2018. What's going on in the market? Well, he's not telling you the whole story, so I'm going to. He said there are two reasons why the market keeps going up. One, passive investing. Passive investing, that people are buying, they're not buying individual stocks, they're buying, what he said, indexes, or ETFs, exchange traded funds that follow the index, and this leads to a steady flow of money into the market. Which kind of begs the question, why in the world anybody would bother watching this buffoon for an hour every night as he, blows out this and blows out that about this stock and that stock. I mean, he's just said everybody is passively investing. And you know something? He's right. I think the majority of folks are, in fact, passively investing in exchange-traded funds. Do you know the bulk of exchange-traded funds were created in 2004, 2005, and Bag of Dawn thinks that those funds were created by the banking industry in anticipation of the crash that was going to come in 2007 and 2008, and it was going to serve as a tool for the central banks and the big banks, the too big to fail banks, to quickly move money in and out of the markets to give the appearance of a real economy and a real market. But that was in 2008. This is 2018, and he's just explaining this to you now. Okay. So let's just assume that he's right. Number two, stock buybacks lead to a never-ending buyer. Well, stock buybacks have been around for a long time. They were around in the 1920s. In fact, the stock buybacks were such a good gig that companies were doing it in the roaring 20s, borrowing money and buying back their shares, reducing the amount of shares on the market, reducing what they call the float, not reducing, but making it easier to beat their earnings per share. And after the 1929 crash, the regulators came in and regulated the crap out of stock buybacks. In fact, it was considered stock manipulation. Now, we have Ronald Reagan to thank in 1982, who, reintroduced or legalized the stock manipulation. Now, it became a real sport really in 2008, 2009, as the Federal Reserve artificially lowered interest rates, making it extremely cheap for companies to borrow money on the cheap and buy back their shares, enriching the CEO and his cadre of executives and not having to pay his workers that much more. But that's another story. But that's stock buybacks. So yes, the stock buyback game has been around and it's been flourishing. So if you're just hearing about it now, you might ask, then what the hell has this Kramer dude been talking about for the last 10 years? Why the hell did I bother listening to him for an hour every night when I could have just bought a passive ETF in the stock market and then just forgot about it? Let it go. It's never ever going to go down. Well, that's basically what he's saying. that the stock buybacks lead to fewer shares outstanding, which leads to never-ending higher prices. Stock nirvana, no risk whatsoever. What's the trick? What's the catch? You guys are smart out there, right? We hope. Well, let me offer a little other perspective. That passive investing does not lead to a more secure stock market. To the contrary, passive investing leads to what we call a commoditization of the markets and bubbles. How is that? Well, the first ETFs were created around commodities like gold or silver or corn, okay? That they were a commodity. And if you wanted to buy corn, if you wanted to buy gold, you had to go to a gold store, you had to buy the gold, you had to store the gold, you had to carry it, insure it, and all of that. But if you could invest into an ETF that tracked the commodity, like gold, well, it'd be a lot easier. And basically, it leads to the commoditization of the market. Now, Bagger Don here does not think that the commoditization of a stock market is a good thing, because the stock market is a collection of individual stocks, and they're supposed to have different values. What's value? Well, we don't have time for that, but they're supposed to have different value. But when you commoditize something, it's kind of like the same, right? If you have, a car, if you're going to buy a car, various cars have different values. The Yugo versus a Honda versus a Lexus versus a Mercedes-Benz, a Rolls-Royce. That those cars, individual cars, have different value, right? But let's say fertilizer for your lawn. Let's say paint for your house. Let's say shingles for your roof. Could you tell me? Would you even really be interested in knowing what the real expensive fertilizer is, or the real expensive paint? Paint's paint. Shingles is shingles. Fertilizer is fertilizer. Commoditization. Stocks are stocks. I can't be bothered. I don't want to be bothered. But I want to get a return on my money. My neighbor says that tech stocks are hot. So I go to an ETF. And I just plow my money into an ETF. An exchange traded fund. And I let them figure out what stocks to own. I don't even care. I don't want to know. Commoditization. It's wonderful when things are going up. Stock buybacks are not new, and as interest rates rise, which everyone's been saying, now the economy is doing so well and that rates are going to rise, as long as they rise for the right reasons, right? Let's get the arrow over here. Oops, we don't want that. Sorry. Let's get that arrow again. Oh, that's my boy Mulligan. He loves this. If interest rates rise, the cost of buying back shares will become expensive. So the reasons that he gives to you tonight, August 7th, 2018, would have you just plow your money into an index and never give it another thought that it's nirvana. I would say to you for the very same reasons that the masses of people are in this market and they perceive it to be just a commodity. And they don't really know, is Tesla really worth $420 a share, or was Leon Musk, I think it's Leon or Ian or Musk, the guy, the CEO, or was he just picked 420 out of his butt because he was smoking some pot? They said it was a pot number, 420. That's what happens when you have a commodity. People don't know. Is Tesla really worth 420 a share, or was he referring to marijuana? Oh, I don't know. But it's going up, right? I don't know about you, but I would consider that a little bit on the scary side. And these stock buybacks, they've been doing it for years. And interest rates are going higher. If you're just learning about this now, that'd be like buying Apple because they're going to come out with a new smartphone. I mean, how many of those have they been selling? Now, I don't have time because I'm going to be cut off, so I'm going to do a second video. But did you know that the ETFs that you're plowing your money into, they do something called, creating, the companies are reducing their float. It's because they have to. They have to, because nobody's trading the individual shares. So they have to reduce the float. But you all are plowing into ETFs, and as you go into ETFs, they actually create more and more shares to accommodate the crowd. Because they can't, an ETF must track the underlying, the basket of stocks that it owns. So if there's more people that got to get in there more than what they're valued, then the ETF has a mechanism to create more shares. And that is a beautiful, easy thing to do as the markets do what? I love this one, they melt up. It's melting up, melting up, melting up, melting up, melting up. Because everybody's just pushing a button. I'm buying an ETF. Martha, I just purchased, sorry Mulligan, he gets excited about this one. But Martha, I just plowed $250,000 into the XLK because I hear that tech stocks are pretty hot right now. And I think it's time to get in the game. So what they do is they create, the XLK creates some more shares and gives them to you. Well, that's fine on the way up. And that's fine from day to day when the volatility is low. But do you remember back in February, there was a 2-week period when the selling started? And everybody went to their machines. Now, they don't go for the individual stocks. They go to the ETFs and they say, sell, get me out. Then they got to destroy those shares. And they got to do it rather quickly. And that's why, in large part, why, and I'm going to show you in part 2, why the prices are melting up, and then you're seeing the markets just crash down and then melt back up, and then crash down and melt back up. Or an individual stock just down 20% overnight, boom, and then melt back up. And then another one down 20% and then melt back up. It's because of the ETF structure. And when you understand how the ETFs are actually functioning, I would suggest to you this is not stock nirvana. This is the stock endgame. And one day, everybody, for some particular reason, and I'm not clairvoyant enough, is going to say, hey, Martha, I want to get out of my ETFs. And if you understand how they create and destroy shares, you're going to realize just how crowded that exit is going to be and how fast the price destruction is going to be. So I would suggest to you, this is not stock nirvana. This is the stock endgame. And Mulligan is weighing into. We're going to do a second video if you like this one. And we're going to explain how these ETFs are constructed, the danger they represent, the complacency they represent, and just how dangerous they are. I'm Bagged On, StockMarketCaddy.com. Now, we trade the markets day in and day out. Some days there's no trading, and some days there is. One way or the other, we're going to be there. But don't put those shares of ETFs in your sock drawer just yet. Good luck.